company, those assets which exist in that company, those property which exist in that company, they are not our own asset, but basically they are assets of who? Of the company. So then the other feature of the company we can say is there's something called voluntary association. Voluntary what? Association, voluntary association. So in this case, a company here, remember by definition, you have said is an association of persons. Association of persons. That association is voluntary. You can't be forced to be a member of a company. It's a voluntary. You must voluntarily accept to be what? Maybe to be a member of a company. You can't be forced. You can't be what? You can't be forced. The other feature of the company, number 9, is basically something called the transferability. Transferability of interest. Transferability of what? Of interest. When talk about the transferability of interest, it basically means that the interest in a company can be transferred. And how is your interest, or basically what is your interest in a company? Your interest in a company is basically measured in terms of the value of the shares you hold in a company. Once you are a member in a company, you have some interest, and your interest is equivalent to the shares you hold in a particular company. You can be able to transfer your interest. You can be able to transfer your shares. Though in some companies, like in private companies, the transfer of the shares is restricted. The transfer of shares is what? Is restricted. So restricted in the sense that you cannot be able to transfer your shares just to any other person. Just to any other person. You wake up today and maybe you decide that you'll sell your shares to any other person. There is some restrictions in relation to that. For example, in a private company, the requirement is that if you want to transfer or you want to sell your shares, you can only sell those shares to the existing members. You cannot sell the shares just to any other person. So the shares can only be transferred to the existing members. But basically, we are saying that there is that transferability of interest. You can be able to transfer your shares in a company. So the other feature of the company, maybe number 10, we can talk over the aspect of management. The aspect of management. So who manage the company in this case? Who manage the company? So the companies basically are managed by an organ which is known as the board of directors. These are basically a feature which applies to all companies, that companies are managed by a board of directors. By a board of what? A board of directors. By a board of what? A board of directors. This board of directors basically comprises of directors who are elected by the members to be in charge of or basically to manage the affairs of what? To manage the affairs of what? Of the company. So therefore, this basically, among others, are some of the features, or basically some of the characteristics of a company. Some of the features or characteristics of what? Of the company. So basically, what that means that if you go to different companies, you'll be able to see those particular features. So those features applies to various companies. So now, next, I want us to look on the classification of companies. Classification of companies, or basically we look on the different types of companies which we have. Classification of companies. Classification of companies. And I hope you're together up to that point. Are we together up to that point? Are we together up to that point? Are we together up to that point? Catherine, are we together? Steven, are we together up to that point? Yes. Yes, so we are together up to that particular point there. Can see someone is having a question here. Yes, so I think we're going to discuss on that case of salmon versus salmon, maybe somewhere. Catherine, we're going to talk about the case of salmon versus salmon and the company limited. Almost at the end, there is somewhere we're going to look on the doctrine of separate legal personality in details, almost at the end of this topic. So we will discuss more on that. Okay, so classification of companies. Now here, we have various ways in terms of how companies are classified. various ways in terms of how companies are classified. Various ways in terms of how companies are classified, or in other terms, we can say we have different types of companies. We have different types of companies. So number one, we have the statutory corporations. Statutory corporations, or in other terms, these are known as the parastatos. So what do you mean by the statutory corporations or parastatos? So these are those companies which are basically formed pursuant to a certain act of parliament, or in accordance with a certain act of parliament, for them to be able to provide some essential services to the members of the public. And these companies here, usually they are under the control of the government, or they fall under the public sector. They fall under the public sector. Public sector entities are those entities which are basically established to provide essential services to the members of the public. And on the other hand, they do not operate with an objective of making a profit. So therefore, these are those companies which are formed in accordance with a certain act of parliament. A good example of this is 𝐎𝐍𝐋𝐈𝐍𝐄. A good example of this is 𝐎𝐍𝐋𝐈𝐍𝐄. If you do some research, you'll be able to see that 𝐎𝐍𝐋𝐈𝐍𝐄 is a statutory corporation which is formed in accordance with the Accountant Act, which is formed in accordance with the Accountant Act. Now, on the other hand, we have seen that these particular entities are basically formed to provide essential services to the members of the public, meaning that these particular entities, these companies are not formed with an objective of making profit, with an objective of making what? With an objective of making profit. And therefore, these particular entities will basically continue operating even if they are making losses. They are making losses because we are saying that their main objective is to provide some essential services to the members of the public. Now, in case they make any profit, that profit may be plowed back, may be reinvested back, or that particular profit may be paid to the government as dividends. Remember, these entities are under the control of the government. So if there's some of the parastatos basically make good profit, and basically what they do, they pay part of the profit they are making to the government as what? As dividend. So we are saying the profit they are making can be plowed back, can be reinvested back, or can actually be paid to the government in form of what? In form of dividends. So how is their capital raised? How do these parastatos raise their capital? These parastatos basically raise their capital through borrowing, and basically that borrowing is guaranteed by the treasury. So the government or the treasury is actually the guarantor. In case these parastatos are not able to repay back the amount of capital they had borrowed, who is supposed to pay that capital is automatically the government. So then from there we have the other type of company, and that is basically the registered. In other terms, you also refer to this as incorporated companies. Incorporated companies. Now, when we talk about the incorporated companies, incorporated or the registered companies, number one, these are those companies which are formed in accordance with the Companies Act of 2015. They are formed in accordance with the Companies Act of 2015, and therefore, like in a private company, the public company, and so on, they are good examples of the registered or the incorporated company. So these are those particular companies which will be formed and also registered in accordance with the Companies Act of 2015. So after these companies have been registered, after they have been registered with a person called the Registrar of Companies, they will be issued with a certificate of incorporation. They will be issued with a certificate of incorporation, in which case then these particular companies shall be regarded to be separate legal entities from their members and also from their shareholders, shareholders. And actually, these companies here, their powers and also what they do, that is something which is clearly defined under their constitutions. And basically, these two companies, they have two main types of constitution. The first constitution is known as the Memorandum of Association, and the other constitution is known as what? The Articles of what? Of Association. So in other terms, you can say that they derive their powers from these two constitutions, the Memorandum of Association and also the Articles of what? Of Association. So then from there, we can proceed and look on the other type of companies, number 3, and that is the chartered corporations. Chartered corporations. Now, chartered corporations, these are those particular companies which are basically formed upon being granted a charter, basically by the president. Usually, the companies which fall under this category are universities. Are what? Universities, because basically what we know is that for any university to be able to offer various programs, various certificate, diploma, degree, master programs, it can only be able to do that upon being granted a charter. Upon being granted a charter by who? By the president. By the president, who is basically empowered to do that under something called the Universities Act. The Universities Act, the president is empowered to grant a charter to a university if, for example, the president will be is basically of the opinion that that particular university will basically do what? Help the country in terms of development and promotion of what? Of education. So therefore, these are those particular companies which are basically formed upon being granted a charter by the president, who we have said is empowered to do that under the Universities Act. And I've said good examples of this are what? Are the universities. Are what? The universities. Then from there, we have number 4. Number 4, we can talk of private companies. We can talk about private companies, or private company, basically. A private what? A company. So private company here is actually defined under the Companies Act, because one, a private company has to be formed in accordance with the Companies Act of 2015. And the Companies Act of 2015 defines a private company as what? Or we can say a private company. This is a company which by its articles of association, of association. So when talk about the articles of association of a company, articles of association of the company, this is actually an internal constitution of the company. An internal constitution means that this is a document which contains some rules and regulations regarding how the affairs of the company will be managed, regarding how the internal affairs of the company will be will be managed. So this is defined to be a company which by its articles of association, number one, restrict the right of members to transfer shares. Restrict right of members to transfer what? To transfer shares. So if, for example, you're a member of a private company, your right to transfer shares is usually restricted. So what does that mean? It basically means that if, for example, you want to transfer, or in other terms, to sell your shares, so there is some restrictions as far as that is concerned. And I think I've given a good example that if, in case you want to sell your shares in a private company, you can only be able to sell those particular shares to the existing members. You can't sell those particular shares to just any other person. So number 2, we say is a company which by its articles of association limit the number of members to 50, limit the number of members to what? To 50. Limit the number of members to 50. The number of members in a private company cannot exceed 50. And number 3 is prohibited from inviting members of public to buy its shares, to buy, or in other terms, to subscribe its shares or debentures. So it basically means that in case a private company wants to issue shares, it can only be able to issue shares or even debentures to the existing members. It cannot be able to invite the members of the public to come and buy its shares or debentures. So therefore, this is the definition of a private company. So we have said is a company which by its articles of association, number 1, restricts the right of members to transfer shares, limits the number of members to 50, and number 3, it is prohibited from inviting the members of the public to subscribe its shares or debentures. Its shares or what? all debentures. Now, before we proceed to look on the other company here, we can proceed and look on the other features, or maybe we proceed and look on more features, or basically the various characteristics of this company, because it is important for you to note that this is basically one of the common type of a company, which is basically formed by individuals to do business. In most of the cases, if today you want to register a company as an individual, you will be registering a private company. You'll be registering a private company. This is therefore one of the common type of companies. So one of the features of this company, number one, is that private companies have a minimum, or basically in other terms, you can say, must have a minimum of one member and one director. One member and one director. So according to the new Companies Act, or basically according to the Companies Act of 2015, so for this company to be formed private company, it requires a minimum of one. A minimum of one. But the repealed Companies Act, that is Companies Act Cap 486, it was requiring a private company to have a minimum of two members. But today, as an individual, you can register your own company as a single individual. So it requires a minimum of one member and one director. One member and one director. So that is one feature of this private company. So the other feature of the private company, we can say that this company can basically commence business upon incorporation. Incorporation is basically the process through which a company is registered with the registrar of companies. So once this company has been registered with the registrar of companies, remember you have said that the registrar of companies will issue something called the certificate of incorporation. That company can start to operate upon receiving that certificate. But we will be able to see if, for example, you are registering a public company, for that company to start operation, it's required to get another certificate still from the registrar of companies known as a trading certificate. But this company, once registered, issued the certificate of incorporation, it can be able to, or it can start, or it can commence business. So the other feature of this company, I think that is something I've mentioned here. It restricts the right to transfer shares. Right to transfer what? Right to transfer shares. So if you are a member of this company, your right to transfer shares is restricted. Now, this restriction for the transfer of shares is achieved in two ways. In other terms, you can say that this restriction regarding the transfer of shares is restricted in two ways. One is through something called director's discretion. Director's discretion. Basically, what this means is that, or basically this document here, that is the Articles of Association, which you have said is an internal constitution. We have said it basically requires that in case you want to transfer your shares, to transfer is basically to sell your shares. So in case you want to transfer your shares in a private company, you must first of all inform the directors of that company. Inform the directors that you want to sell your shares. Now, once you have informed the directors are empowered by this document, by the internal constitution, basically to do what? To decline you, or basically the directors do have that particular power not to give you a permission, or basically a consent to go ahead and basically do what? Sell your shares. They can tell you that you will not sell your shares. You'll not do what? Sell their shares. In other terms, once you have informed them you want to sell your shares, they can decline to register that transfer of shares. So once they have declined to register your transfer of shares, it means that you can't be able to go ahead and you do what? You sell your shares. So that is one way through which the free transfer of shares is restricted. Number two, it is also restricted through something called the pre-exemption clause. Pre-exemption clause. So this is still a clause which is contained in this document, Articles of Association, and which basically requires that in case you want to sell your shares in a private company, you must offer for sale those shares to the existing members. You can't offer for sale those shares to just any other person. This clause requires that you must offer for sale all the shares to who? To the or basically you must offer for sale those particular shares to the existing members of what? Of the company. This particular clause is meant to ensure that in case you are selling your shares in a private company, you are not just selling those shares to any other person, but basically you are selling those shares to who? To the existing shareholders of that company, to the existing shareholders of that wood, that company. Yes, so those are basically two ways through which now this free transfer of shares is actually what is actually restricted. Maybe we can also say that or the other feature of this company here, number 4, we can say limit the number of members to 50. Limit number of members to what? To 50. So the number of members in this company cannot exceed what? 50. Cannot exceed what? 50. So those are basically some of the features of this private company. So then we can proceed and look on the other type of company. Remember, this was under number 4. So number 5, we have public company. Public company. What is a public company? Public company is also defined under the Companies Act. And the Companies Act defines this, or we can say that a public company, this is a company which by its articles of association, number one, do not restrict members' rights to transfer shares. Members' rights to do what? To transfer shares. So in a public company, the right of members to transfer shares is not what? Is not restricted. And number 2 here, we can say that this one is not prohibited. From inviting members of public to buy its shares. Not prohibited from inviting the members of the public to do what? To buy its shares. So this company can invite the members of the public to buy, or in other terms, to subscribe its shares or debentures. And we will be able to see that whenever a company is inviting the members of the public to buy, to subscribe its shares, that company does that by issuing something called a prospectus. By issuing a prospectus. A prospectus is any invitation by the company to the members of the public to buy or to subscribe its shares or what? Or debentures. Number 3 here, we can say its certificate of incorporation. Each certificate of incorporation clearly states that it is a public company. State that it's a public what? Company. So this is the definition of a public company under the Companies Act. Under the Companies what? Under the Companies Act. Specifically, if you go to, and this is a document, in fact, you should be able to download. If you go to any browser, you type Companies Act of 2015 PDF document, you should be able to get this act. Yes, so it's good you have this particular act, because I've said most of things we are running here, they come from this act. Specifically, for example, in this case, if you download this act and you go to section 10, of this act, this is where you get this definition. That's why you get this word definition. Yes, that's why you get that definition of a public company. Now, in this case, it is also important. There is something I've mentioned here in relation to the features of the private company here, where we have said a private company can commence business upon incorporation. Once a company is incorporated or registered with the registrar, it will be issued with a certificate of incorporation. We have said that this company can be able to commence business upon receiving that certificate. But this one, that is a public company, it can only be able to commence business after receiving another certificate called a trading certificate. Trading certificate is not a business permit, because some students tend to confuse this with a business permit. A business permit is you get that from the county government. So, but a trading license, this is still a license which is issued by the registrar of companies. But a company is only issued with that certificate And that only applies to public company once the company has been able to raise something called minimum subscription. Minimum subscription is basically the minimum amount of capital which is required by the company for its operation. Once this company has been registered with the Registrar of Companies, it is required to issue a prospectus inviting the members of the public to start buying its shares so that it can raise the necessary capital. So automatically the directors will have said that, or basically will have agreed on the minimum capital required by that company. So once that capital has been raised, the minimum capital required has been raised through the issue of shares to the members of the public. That is the only time the company can be able to start operation. And once the company raises that amount of money, it is required to notify the Registrar of Companies that they have been able to raise the minimum capital required. Once the registrar is notified, then the registrar will proceed and issue that company with another certificate called a trading certificate. Upon the receipt of that certificate, that is the only time a public company can be able to start operation, operation. And therefore, that capital, minimum capital required, which you're referring to as the minimum subscription, is the amount of capital required by the company to pay the preliminary expenses. Preliminary expenses are the expenses which are incurred during the formation of the company. If today you are forming a company, kuna zile expenses uta-incur. So maybe you need to pay, there is something called a stamp duty payable to the government. You also maybe the registration of or the formation of the company maybe is done by your lawyer. So he will be charging with some small fee. So all those costs you incur in registering a company refer to them as preliminary expenses. So minimum subscription must be enough to pay preliminary expenses, must be enough to pay for any asset or property acquired by by the company, must also be enough to provide the company with sufficient working capital. So working capital is basically money required for operation, but maybe buying inventory, paying the day-to-day operating expenses of the business, and so on. So therefore, once this company has been able to raise that amount of money, it is supposed to notify the registrar about the same, and basically the registrar will issue that company with a trading certificate. That is the only time this company can be able to start or operating. Yes. So are we together up to that point? If we are together, want us we move to the next thing. Are we together up to that point? Catherine, Stephen, Zido, are we together up to that point? Are we together up to that point? Okay, so I want us next we look on what? We look on the features, not the features, Lana. I want us to look on the differences between these two types of companies, differences between the private and the public, private and public companies. So what are the differences? Which differences exist between these two companies? Which differences exist between these two companies? Remember, I've said these are the common types of companies which are formed by individuals to do business, either private or public companies. So which differences exist between these two companies? I think we have mentioned, we have come across some differences, like this one require a minimum of one member. For it to be formed, it requires a minimum of one, whereas these require a minimum of 7 members, a minimum of 7. So this requires a minimum of one director, whereas this one requires a minimum of 2 directors. 2 what? 2 directors. The other difference is that this company, that is private company, is not required to hold an AGM. As per the Companies Act of 2015, a private company do not have any mandate, do not have any responsibility of convening. It may hold an AGM, but it's not a requirement under the Companies Act. But this company here must convene an AGM. And actually, we will discuss more on these meetings, AGM, in the topic of companies meeting. We will see what is an AGM, when is AGM supposed to be held, and basically which business are transacted during such meeting. So the other difference is that this company here, we have said, can commence business after receiving certificate of incorporation. This company, for it to commence business, we have said, other than receiving this certificate of incorporation, it must additionally receive a trading certificate. The other difference is that private company here, basically you have said restrict the right of members to transfer shares. Restrict the right to transfer what? Shares. But this one does not do what? Does not restrict. This one does not restrict the right of members to do what? To transfer shares. Does not restrict the right of members to transfer what? To transfer shares. On the other hand, this one cannot invite the members of the public. Cannot invite the members of the public to buy shares, whereas this one can do what? Can invite the members of the public to buy its shares. Can invite the members of the public to buy its what? Its shares. Can invite the members of the public to do what? To invite or basically to supply it what? Its shares. Maybe the other difference, we can say private company. Here the directors are not required in the qualification shares. Are not required to obtain the qualification what? Shares. So the qualification shares generally, these are the shares which the directors of the public company are required to obtain and pay within a period of 2 months from the date they were appointed. So that applies to directors of which company? Public company. So here the directors are not obtain the qualification shares, but here the directors are required to do what? To obtain the qualification what? The qualification shares. So those are some of the differences which exist between the private company and also the private company and the private and the public company, private and public company. So next, I think we can look on like the advantages of a private company over public company. So what are some of the advantages of private company over public? So we have a number of advantages. One, we can say that this company here, private company, can be able to commence business upon incorporation. So once this company is registered with the Register of Companies, it can be able to commence business. It can start operating. This company is not required to obtain trading certificate. That is one of the advantages. Number two, because for this company to start operation, other than being issued with a certificate of incorporation, it must then wait and acquire the other trading certificate. Now, the other advantage of this company is that for it to be formed, it requires a minimum of one. It requires a minimum of one, meaning that to form a private much simpler because just one person is what is required. So the other advantage of this company, that is a private company, this company is not subjected to publicity requirement. Is not subjected to publicity requirement. What does that mean? It basically means that this company here is not required to, for example, one, publish its financial statements, make its financial statements available to the members of the public, which applies to public company. Public company must publish its financial statement, must make its financial statements available to the members of the public. Equally, in a public company, most of its documents, including MOA, AOA, and public documents, they are documents which can be accessed by any member of the public, which does not apply when it comes to what? When it comes to private companies. So the other advantage of this company is that private company is not required to hold an AGM. Remember, this is an advantage because if a company has to convene an AGM, we know that there are some costs which will be incurred, some logistical costs which will be incurred. The company must get a venue. Maybe the company will need to bring an MC. The company need to have other logistics put in place. All that means that the company will have to incur some expenses. On the other hand, if, for example, this company, the public company, fails to convene this meeting as required under the Companies Act, it can be fined. It can be required to pay a fine to the registrar because it is not complying with the requirements of the requirements of what? The requirements of the requirement of what? The requirement of the company's what? Act. So those are basically some of the advantages of a private company. But on the other hand, we have various advantages of a public company over private. So what are some of the advantages of public company over private? One is access to capital. So if these two companies want to raise capital, the company which can be able to raise capital very fast and easily is the public company, because this company can issue shares to the members of the public, unlike private company, which is restricted from issuing its shares to the members of the public. So we can talk of easy access to capital. Number two is something called easy exit strategy. So if you have invested in a private company, it is basically easy to exit, because you can just be able to sell your shares anytime and to any other person, unlike in a private company whereby your exit may be declined. Maybe you want to sell your shares, but the director tells you no, you can't sell your shares. In a public company, there is an easy exit strategy. So the other one is basically about spreading of risk. So in a public company, shares are issued to so many shareholders. So the risk has been spread to so many shareholders, unlike in a private company whereby shares are issued to maybe few individuals, to few individuals. And the other one is about the ease of selling the shares. Ease of selling the shares. If you want to sell your shares, you can be able to do that with ease. And there is no much restrictions in relation to that. Yes. So that basically some of the advantages of the public company over private. Now I want us to take a short break. I think we can just take a short break of 10 minutes, and then we come back. We look on the remaining types of companies, the other types of companies, and maybe we will wind up by looking on. We see whether we will be able to wind up on this. But basically, I want us first of all we take a short break. Then we come back after that short break of 10 minutes. We come back at exactly 1:18. We continue. Yes, so let's continue. I hope you're back. Yes. Are you back? Catherine, Stephen, Zido, are you back? So that we continue. Are you back? Okay, so I want us to continue with the discussion here. And I think we have just discussed on some of the advantages of a private company over public, and also the advantages of a public company over a private. So next, I want us to look on the other type of company, number 6, and that is the unlimited company. So unlimited company is what? So unlimited company basically is that particular company where the liability of members is unlimited. What does that mean? The liability of members is unlimited. It basically means that if, for example, this company that is not able to pay its debt, then what will happen is that the members of such a company will be required to come in and contribute money to pay those particular debts of the company. So meaning that this company here is just the same with a partnership, is the same with a sole proprietorship business. So the only difference is that this company one will be having perpetual succession, and also the company will be having the separate legal personality, but the liability of members is unlimited. Number 7, we have company limited by guarantee. And the company limited by guarantee, number 1, these are those companies which do not have share capital, Actually, this company have like 3 features. These companies, number 1, do not have share capital. What does that mean? It basically means that this company do not raise capital by issuing shares. Simply because mostly company limited by guarantee are the not-for-profit making organizations, like the NGOs which are formed, they fall under this category here. And basically what we know is that NGOs rely on donations. They are funded by donations and also maybe maybe grants from the government. Maybe, for example, the government would a grant. They do not have share capital. They do not raise capital by issuing shares. Number two, number two, these particular companies here are not formed to make profit. Not formed to do what? To make profit. They are not formed to make what? A profit. And that's why I've said NGOs, they fall under this what? A category. And number three, these companies or the liability of members. The liability of members, the liability of members is limited by what? Is limited by guarantee. Is limited by what? By guarantee. So by saying that the liability of members is limited by guarantee, it basically means that when these companies are basically to be formed, each member of this company basically make a commitment that in case the company is not able to pay its debt, then they will come in and contribute a certain amount of money to help the company in terms of paying its debts. So if you are a member here, so during its formation, you must commit yourself to contribute a certain amount of money to help the company in terms of paying its what? Its debts. That's what you mean by the liability of members being limited by what? By guarantee. So these are basically the features, the three features of these particular companies here, which are company limited by what? By guarantee. So then we can proceed and look on the other type of, or the other classification of a company. That was number seven. Number seven. So we have number eight, and that is a company limited by shares. Company limited by shares. So when talk about the company limited by shares, these are those particular companies where the liability of members is limited by shares. The liability of members, liability of members is limited by shares. Is limited by what? Is limited by shares. So what this means is that in case this particular company is not in a position to pay debts, then as a member of this company, you will only be required, or basically as a member of this company, the obligation which you have as far as the payment of those debts of the company is concerned is paying the amount of money which you have not paid on the shares you have been issued with. For example, you have been issued with 10,000 shares. Maybe there is some amount of money you have not paid for those shares. So what you'll be required to do in this case is you pay that amount which you have not paid on your shares to help the company to raise money to pay its debts. That's basically what you mean by your liability being limited by shares. Your obligation as far as the payment of the company's debt is concerned is limited to paying any amount of money unpaid on your shares. If your shares are fully paid, then can you be required to come in and pay any amount of money here? Automatically, no, because your shares are fully paid. So that's what we mean by company limited by what? By shares. So then from there we have a holding company, holding and a subsidiary company. Holding and subsidiary company. I think in this case, we can start by defining what is a holding company. So holding company, essentially, this is a company which has acquired the majority of the shares in another company. For example, we are told 𝐴 Limited has acquired more than 50%. That is majority of the shares in B Limited. This company here is the one which is called the holding company. The holding company. In other terms, this one is also called the parent company, the holding or the parent company. For us now, this company here is called the subsidiary company. It's called the subsidiary company. So, but by definition, how do we define a holding company? So a holding company, this one is defined under the Companies Act, specifically Section 3 of the Companies Act of 2015. And actually a holding company, we say, this is a company, basically we have four definitions. Is a company that number one controls the composition of the board of directors, controls of another company, controls the composition of the board of directors of another company. So a company is said to control the composition of the board of directors of another company if that company is the one which appoints majority of the directors. For example, A Limited, taking into account its whole majority of the shares in B, A Limited will be the one which appoints majority of the directors of B Limited. It therefore controls the composition of the board of directors of B what? Limited. Number two, we say is a company that do what? That controls more than half. Controls more than half of the voting rights of the voting rights of another company. Voting right of another good company controls more than half of the voting rights of another company. If A Limited hold majority of the shares in B, it basically means that A controls more than half of the voting rights in B what? In B Limited. And number three, holds more than half of the issued of the other, that is of the other company share capital. Other company share capital. So this company holds more than half of B Limited share capital. So therefore, this is the parent, whereas B is what? Is a subsidiary. And then number four here. Number four, we can say it is the holding company of a company. It is a holding company of a company that is of a company, okay, of a company which is another company holding company. So what have we said here? We have said that the holding company is a company that is a holding company of a company which is another company holding company. What does that mean? So let me illustrate that so that you understand. Assuming you have three companies, A Limited, which basically has acquired more than 50% of the shares issued by B Limited, and then this one hold more than 50% of the shares issued by who? By C. So in this case, you can see A controls B simply because this one has or basically acquires or hold more than 50% of the shares issued by B, and then B in turn controls what? Controls C. So this company controls this, and this in turn control C. So therefore, in this case, we can see A has got some indirect interest, not indirect interest, indirect control over C. A Limited has indirect control over C. So therefore, A Limited will be a holding company as far as company C is what is concerned. So this definition number 3, definition number 4 of a holding company basically it applies to this. It applies to this, where we are saying A is a holding company of company C, simply because we are saying A is a holding company of a company, is a holding company of this company, is a holding company of a company which is another's what? Holding company. So this is a holding company of this, which in turn is a holding company of another company. So therefore, A Limited is a holding company of company what? Of company C. So that is the definition of what we refer to as a holding company. So if you come across a question required to define a holding company, you need to remember those 4 definitions. Those 4 what? Definitions. Okay. So next, number 10, I want us to look on something called the foreign companies. Foreign companies, in other terms, these are known as companies incorporated outside Kenya. Incorporated outside what? Kenya. So we'll talk about the companies incorporated outside Kenya. These are those particular companies which are registered or basically incorporated in any other country other than Kenya. And this company have started operating in what? In Kenya, have started operating in Kenya. For example, a company registered in Uganda, but that company has started operating in Kenya. Now, that company, we refer to it as a foreign company. Now, the requirement of the Companies Act is that for that company to start operating in Kenya legally, it has to be registered with the Registrar of Companies as a foreign company. So that company will be required to make an application with the Registrar of Companies for it to be registered in Kenya as a foreign company. Once the registrar receives that application, he will go ahead and basically register that company, provided that application for registration meets all the requirements of the Companies Act. And that company, once registered with the Registrar of Companies, it will be issued with a certificate of registration, meaning that it has been registered in Kenya or it has been registered by the Registrar of Companies as a foreign what? As a foreign company. As a foreign what? As a foreign company. As a foreign what? A company. Yes. So that's basically the other type of company. And then we also have something called the corporation aggregate. I'll define this together with something called the corporation sole. So these are basically not per se types of companies, but these are types of legal entities or legal persons. So when we talk about the corporation aggregate, this refers to those associations which comprises of two or more persons. And mostly now the private companies, that is the public companies, or those companies which comprises of two or more persons, they are good examples of corporation aggregate. Associations which are comprises of two or more persons, which have been registered and also recognized as legal entities, separate and also distinct from their members. Corporation sole, basically these are the legal offices which are actually deemed to have the same status with companies. They are those one-man offices, which are basically established by the various provisions of the law. For example, the office of the president, the office of the attorney general, the office of maybe deputy president. Those are one-man offices which are established under the various provisions of the law and actually recognized to be legal entities, which are basically separate and distinct from their members. Members. So those are basically the various types of companies, which basically you need to be aware of. I think maybe some of the questions which I've seen here, maybe like I think last Question 1B, question 1B. Question 1B. So once you get that question, please confirm. Once you get that question, please confirm. Once you get the question, please confirm, please confirm. Yes, are you there? If you have the question with you, please confirm. Please confirm. Yes, so I hope you are there. Are you there? Are you there? Do you have the question with you? Yes or no? Are you there? If yes, yes. Okay. So what are we told here? What are we told? So the question is, 𝐎𝐿𝐶 Limited leased a factory to Tiana Limited with effect from 1st July 2022. The lease is for 4 years at an annual lease rentals of 4 million payable in arrears. So the lease contract provided that the lessee shall be responsible for the insurance and maintenance of the factory during the lease term. The implicit rate of interest in the lease is 15%. So what are we required to do here? We are required to demonstrate with the suitable calculations the accounting treatment of the above lease transaction in the financial statement of 𝐎𝐿𝐶 Limited, the 𝐅𝐎𝐂, for the year which ended 30th of June 2023, 2024, 2025, and 2026. The marks allocated there were 10 marks. You can see the information which are given here, very small information, and also the marks allocated are 10 marks. Now, the first thing we need to do is basically to understand what you're required to do. We are required to demonstrate with the suitable calculations how this particular transaction, will be accounted for in the books of account of the 𝐎𝐿𝐶 Limited. 𝐎𝐿𝐶 Limited is the lessor, who is the owner. Now, what you have said is that when the owner of the asset is accounting for the lease, the first thing he needs to do is basically to determine whether the lease is a finance lease or basically the operating risk. That is the first thing we need to do. We need to determine this risk. Is it a finance? Is it an operating risk? Now, which information are we given? Remember, I've said there are usually 4 criteria which you can be able to use to evaluate whether this risk is finance or operating. I think the information which you're given in our question here is what we have in paragraph sentence number 2. Can you go to sentence 2, sentence 3 actually? Sentence 3, and you are told that this contract provides that the lessee shall be responsible for the insurance and maintenance of the building during the lease term. So the person who leases the asset shall be responsible for what? For insurance and also what? Maintenance. And also what? Maintenance. So the person who leases the asset, that is the lessee here, the lessee is the one to be responsible for this. Basically, what that means is that this, in this particular case, the owner of the asset, who is 𝐎𝐿𝐶 Limited, transferred the risk and rewards, because I've said that if you have the responsibility of insuring a building, if you have the responsibility of maintaining a building, it basically means that all the risks associated with that particular building, they have been transferred to you. That's why you are required. Can you insure this building? If something happens to the building, maybe you are the one to incur the cost of maybe doing what? Repairing that building. That's why you have to do what? To insure it. That's why you also have the responsibility of maintenance. So therefore, in this particular list, the owner of the asset transferred the rewards and risk associated with the asset to the lessee. And if that is the case, then it means that this is a finance risk. This is a finance risk. And basically, that's the first thing you needed, or the candidate needed to do here, to determine whether this is a finance or an operating. Or an operating. Yes, this one is basically a finance. So we can say this is what? Is a finance what? Is a finance. It is since what? Since the receipt, although this one is not required, remember this is basically for your understanding purpose. So since the receipt is responsible for what? For insurance and what? For insurance and maintenance. For insurance and what? Maintenance. In other terms, the risks associated with the assets were transferred to the receipt. Okay. Now, having said, we have said that the owner of the asset, or basically what the owner of the asset will need to do, number one is to recognize the asset, and number two, to compute something called the net investment in the risk. And basically that's what we need to do here, because you can see we are not even given the value for this asset. So we need to compute what? The net investment in the risk. The net investment in the risk. So we need to compute the net investment in the risk. Net investment in the risk. Investment in the risk. Net investment in what? In the risk. And basically this one we computed on the date when the asset was leased out. So we are told in the first sentence, Fox Limited entered into or leased a factory to Tiena with effect from 1st July 2022. That is basically the date we determine what? The net investment in the risk. Net investment in the risk. So how do we compute this one? I've said basically we add 3 values. Remember that format which I've given you. So I've said we add the present value of the risk rentals receivable, risk rentals receivables, risk rentals receivables. So to this we add the present value of the guaranteed residue amount. The guaranteed residue amount. To this we also add the present value of unguaranteed residue amount and guaranteed residue what? Residue amount and guaranteed residue amount. I've been able to explain, I've explained what is the guaranteed residue amount, what is unguaranteed residue amount. Basically, I've said the guaranteed residue amount. This one will only be given whereby there is an agreement between the owner of the asset, the lessor, and the lessee that at the end of the lease term, the asset will be purchased by the lessee. How much amount will the lessee pay when buying the asset? If you check on this particular question here, I think we don't have such information. The only information which are given here, specifically in sentence 2, is the annual rentals to be received. The annual rentals to be paid of 4 million. There is nowhere we given information about there being an agreement between the owner of the asset and the lessee that the lessee will buy the asset at the end of the lease term. So we don't have this value here. The guaranteed residue amount, equally we don't have what? And guaranteed residue amount. It basically means that the net investment in the lease will be equal to this, the present value of the lease rentals receivable. Are we given the amount of money the owner of the asset will be receiving each year? Yes. So that information we have it in sentence 2. We are told the lease is for 4 years. So this is basically a lease for 4 years. Year 1, year 2, year 3. So how much amount will the owner of the asset be receiving? So we are told is a lease for 4 years at annual lease rentals of 4 million payable in arrears. Payable in arrears. In arrears means that that amount will be received by the owner of the asset at the end of each year. So that will be payable in what? In arrears. Payable in what? In arrears. So basically what we need to do here is to discount this. So how do we discount this one? We take 4 million. 4 million. We multiply that with the PVVA, the present value interest factor. Are we given the interest rate? Yes. At the interest rate of 15%. And basically for how many years? 1, 2, 3, 4. For 4 years. For 4 what? For 4 years. So basically what we need to do is to compute this particular value here. So we need to first of all to work out this. So remember the formula which we use. 1 minus 1 plus R, which is 1.15 raised to power negative 4 all over R, which is 0.15. Can we first of all work out this? Let's first of all work out this. we work out this. So we have 1.15 raised to power negative 4. We less than from 1, or basically 1 minus answer divided by 0.15, and then we multiply that with 4 million. 4 million. So in this case, I'm getting a value of 11 million. 11 million 419 913. 913. Is that what you're getting? The final answer? The final answer, the final answer, the final answer. Yes. So basically that is what I'm getting here. That is what I'm getting here. Yes. So basically take into account we don't have these two values. So the net investment in this is 11, 419, 9 what? 913. So basically these represent what the owner of the asset will basically receive over what? Over the income. Now, even before we proceed to the next step, assuming this amount is receivable in advance. For example, this one is receivable at the start of year 1, start of year 2, start of year 3, start of year 4. Assuming that is the case. Now, how do we discount this one? This amount which are receivable in advance. How do we discount this one? How do we discount this one? So the same formula here, we change this one to. Okay, there are two approaches. Remember, there are two approaches. Can you remember a formula? This one. Can you remember this formula you did in the topic of FM? 1 minus the 1 plus R raised to power negative n all over R, and then 1 plus R. Can you remember something like this? Can you remember something like this? Yes. Alternatively, instead of using this, you see this amount, the present value of 4 million, which is paid, which is received at the start of year 1, its present value is still 4 million. So you can take 4 million and then you discount these three amounts here. Yes, so you discount those three amounts, this and this and this, but basically here now your n will be what? Will be 3. But you must remember to take this one, 4 million. It's the present value of 4 million received at the start of year 1 is 4 million. Yes. So if you happen to come across such a question, basically remember that. Now, having this, what do we need to do? We need to amortize it. We need to amortize this. So we amortize this by basically preparing the risk amortization schedule. There is amortization schedule. There is amortization schedule. A schedule. There is amortization schedule. Yes. What is the question here? Will the 4 million at the start? Yes. 4 million. Remember this one. When basically accounting, when computing net investment in the list, we take into account the amount to be received. Whether it was received at the start, you must capture that. Unlike what we did yesterday, whereby you said in computing the obligation, in computing the risk liability, we don't capture the amount which has already been paid. Yes. But in this case, you have to capture that. So here we have a column for the years. Remember, this is the risk for 4 years. For 4 years. Then the next column here will be for the net investment in the risk at the start of the year. This one. We can just refer to that as net investment in the risk. NIL. Net investment in the risk. Balance at the start of the year. Balance at the start of the year. Then the next item here, take into account these risk rentals are received at the end of the year. The next column here will be for the interest. And basically this will be an interest income. The owner of the asset has invested in the risk. So he'll be recognizing something called the interest income. So this one will be computed at the rate of 15%. Then the next column here will be for the risk rentals. The risk rentals which was received. The risk rentals received. And finally, the net investment in the risk at the end of the year. Balance carried down. Balance carried what? Down. That's basically how our risk amortization schedule will look like. Now, having this, we basically need to proceed and prepare our risk amortization schedule. The first year started on this date. 1st July 2022. So automatically that year will add on that year of June 2023. And remember that this is for 4 years. The other year, that year of June 2024, that year of June 2025, that year of June 2026. That's why if you go to the requirement, basically we are required to show how these salaries will be accounted for in the financial statements of Fox Limited, basically for those 4 years, 2023, 2024, 2025, 2026. Yes. So we start with the net investment in the list at the start of year 1, which you have computed here. And that is 11,419,913. So we compute the interest being 15% of this, being 15% of that, 15% of 11,419,913. Yes, what are you getting as our interest? As our interest income? 1712,987. Is that what you're getting as the interest? As the interest income? As the interest income? Yes, yes. So then from there, we know the amount which was received at the end of year 1 is the 4 million. So 4 million is the amount which was received at the end of year 1. So how do we compute the net investment in the list at the end of year 1? So we take this one, net investment in the list at the start of year 1, A, plus interest income, B, minus the lease rentals received. So we have A plus B minus what? Minus C. Minus C, like that. Yes. So let's compute this one. So we take 11,419,913 minus 4 million, plus interest minus 4 million. Yes, what are you getting here? 91,32. 8 what? 890. 890. 890. 890. Is that what you're getting? Is that what you're getting? Is that what you're getting? Okay. So then we move to the next year. So this will be the opening balance. This one will be the opening balance here, 9132, 890. So what will be our interest? We get 15% of that. 15% of that, which will give us what? 1 million. Three what? 1,369,930. 930, 934, 935, 935, 935. What are you getting here? What are you getting? What are you getting? Okay, so then the lease rentals received still is 4 million here, and we compute the net investment in the lease. The net investment in the lease at the end. So the net investment in the lease, I hope that is the figure given by Fred there. By Fred, 6502, 02,832. I hope that is the value. Fred, that value is correct. Yes. Please confirm what you're getting here. Yes, 35,02,832. 832. 832. Are you getting that value? Are you getting that value? Are you getting that value? If you're getting that value, please confirm. Okay, so then this now will be the opening balance here. 65,02,832. So what will be the interest income? So we get 15% of that. 15% of that, which will give us what? 975, 425, 425. Is that what you're getting? Yes. So basically, then we know that at the end of year 4, this is the amount which was received. So we compute the net investment in the list at the end of year 3. Yes, and that will give us what? 478, 3478, 250 what? 257. Yes, so that will be the opening balance, yeah? 3478, 257. So what will be the interest? 15% of that. So which will be 521, 739, something like that. The amount which was received at the end of year 4 is basically 4 million. So this one, even without computing, should actually give us 0, or basically a figure which is insignificant. What are you getting? You may get a figure which is not significant, an insignificant figure. An insignificant figure, what are you getting? What are you getting here? Should get, you can see we have a figure of a 6. Is it 6? But it should essentially be 0. Should be 0. So the reason why you're not getting exactly 0 is because we have rounded off. Now, is that what the examiner is requiring? Is this what the examiner is requiring? Automatically, no. That's why you can see, if you go to the requirement, we are basically required to demonstrate with suitable calculations. These are the calculations, the accounting treatment of the above list transactions in the financial statement. So in this case, if you come across that question and think that is something explained, you must prepare a financial statement extract to show what is supposed to be recognized over this period of 4 years as an income, or basically as an expense in the income statement, and what was supposed to be recognized in the statement of financial position. Now, in the income statement, put the owner of the asset, which this company which own the asset will recognize there is this amount here. Remember, our company has reached out the asset. It is like the company has invested in a lease. So in the income statement, the company will recognize this. So in the statement of profit or loss, which is the same with the income statement, remember this an extract part of the income statement. So we need to have our 4 years here. 30th of June 2023, 30th of June 2024, 30th of June 2025, 30th of June 2026, like that. So this one will be recognized here, or which it will be recognized as part of the other incomes. Remember, other incomes, we add them to the gross profit. To the gross what? Profit. We add other incomes here, other incomes. So we will have interest income. So the interest income for the first year is this one, which is the 1711. That is 17. Which figure is this? This should be. What should not be here? Is it 1? Should the figure be 1712? Yes, 1712. 1712. 987. And then year 2 we have 13. 69. 935. Then we have 975. 425. And then finally we have 521. 739. So that basically what our company recognizes as an income within what? The statement of profit or loss, or basically in the income what? Statement. What about in the statement of financial position? Statement of financial position. Now here, our company will recognize something called the net investment in the lease, of which this net investment in the lease we have said to the owner, to the lessor is an asset. To the owner is what? Is an asset. The company has leased out the asset. The company will be earning some income from leasing out that asset. So this net investment in the lease at the end of the year is an asset. But equally, just like what we did yesterday, this net investment in the lease is basically split into 2. Non-current assets and basically current assets. Current assets is the amount to be received from the lease within the next 1 year. This is the amount to be received from the lease with for period beyond 1 year. For period beyond 1 year. So therefore, this net investment in the lease, part of it would be captured here as a non-current asset. as a non-current asset. Remember, we should have 4 years, 30th of June 2023, 30th of June 2024, 30th of June 2025, 30th of June 2026. 2026. So we will have net investment in the risk, net investment in what? In the risk, under the non-current asset, and also under the current asset, and also under the current assets. Under the current assets, we will also have what? We will also have net investment in the risk. We will also have net investment in the risk. Net investment in the risk. In what? In the risk, net investment in the risk. And just like what we did yesterday, the amount to be recognized here is a non-current asset. Remember, I've said that this is the amount to be received for a period exceeding 1 year. So in the first year, we will take the net investment in the risk at the end of year 2, this one. So, yes. So that is basically what we recognize here as a non-current asset, this one. 6502,832. In this year, we take this one, which is 34,78,257. What about this year? We take this one, which is basically 0. And this year, we take for 2017, which is equal to what? 0. You can see there is not much difference with how we were treating the risk liability as non-current and current. Then we say to determine the net investment, or actually to determine the amount to be recognized as a current asset here, we will get the difference here, the amount, the difference between the net investment in the risk at the end of year 1 and at the end of the year 2. Because the reason why this amount has reduced is as a result of the amount which was received within that year, So, yes. So what is the difference between those two values? This and this. So we have 90 what? 91, 32, 890 minus 65, 02, 832. So that will give us 2630, 058. Then we get the difference between those two values. That is 6502, 832 minus 34, 78, 257. That will give us what? 3024, 575. Can you confirm whether you're getting that value here? Is that what you're getting? Is the difference between those two values? Is that what you're getting? Yes, that is confirmed. Then in the next year, we get the difference between these two values there, which is this one. That is 34, 78, 257, like that. And then the last year is the difference between 0 and 0. So basically that one will be 0. That one will be what? Will be 0. So therefore, that basically what is required as far as that question is concerned. And thus you can see the marks allocated there for significant marks, 10 marks, because equally you can see the work which was required there is equally some work. We have some work which is you have to do before you prepare those financial statements, what are extra. So I want us to take a short break of 10 minutes. We come back and then we see what we're going to discuss. I don't know whether we have any other question on this, or now we are going to proceed and look on how we account for the sales risk back. Remember, these are all this what you did in FR, but basically I said there is another concept, sales risk back. Let's take a short break. We come back, we see what we are going to discuss after the short break. So we come back after the short break of 10 minutes. We come back at exactly 9:20. Yes, so I think we can proceed. I hope you're back. Are you back? If yes, please confirm. Are you back? 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 Okay. So I can see there was another question on this last sitting. Let's go to the paper for last sitting. That is August of 2025. August 2025. There was a question on this. Let's look on that question. It basically means that we're going to finish on this topic in our next class because there is another concept which is remaining, and that is the sales risk-back transaction. So the past papers, let me reshare them in the class was up group there. already shared. We got to this question for last sitting, August of 2025. So this was a tricky one, although not that tricky. August of 2025. Specifically, this question number what? This was question number 4B. Question 4B. So if you're there, please confirm. Please confirm. Please confirm. August of 2025. Question 4B. Question 4B. Question 4B. Question 4B. Yes, I think maybe for those who are taking the paper, you came across this question. I don't know whether you were able to do it, but it was a tricky one, although not that difficult. Are you there? Yes. So what are we told? What are we told as far as this question is concerned? What are we told? So the question is on 1st of April 2022. Okay, that it should be part B. So we are told on 1st January 2024, Pabana Limited acquired a large-scale custom-made equipment and leased it to Mambo Limited for 6 years. So it basically means that who is the owner of the asset here is Pabana Limited. So the asset was leased to who? To Mambo Limited. So Pabana Limited is the lessor, the owner of the asset. Mambo Limited is the lessee. So we are told Mambo Limited, who is the lessee, made an annual payment of 10 million, commencing on 31st of December 2024. The equipment has a useful life of 7 years. Mambo Limited is responsible for ensuring and maintaining the equipment and is required to pay an additional 1.5 million at the end of each year, provided that the defined performance target is met. So there is some information which are given in that sentence, which basically will help us in terms of knowing that from the owner's point of view, from Pabana Limited point of view, this is a finance simply because we are told Mambo Limited is responsible for ensuring and maintaining the asset. So from the owner's point of view, this is what is a finance lease. So then in paragraph 2, we are told Mambo Limited has guaranteed that the value of the equipment as at 31st of December 2029 will be will not be less than 1 million, although Pabana Limited anticipates that the open market value as at that date will approximately be 2.5 million. What does that mean? In this particular question here, we are given something called the guarantee residue amount. So the guaranteed residue amount basically is the amount which is guaranteed by who? By Maboreo, because you're told Maboreo Limited basically has assured the owner that the value of this particular asset will not be less than 1 million. So that means that if Maboreo Limited decide to buy this asset, he will pay an amount of how much? 1 million. But you are told now the owner of the asset, that is Pabana Limited, if he is to offer for sale this particular asset in an open market, he will be able to sell it at 2.5 million. So it basically means that from this information, we can be able to proceed and we compute something called the unguaranteed residue amount. So who can tell us what would be the unguaranteed residue amount from this information which we have? So Maboreo Limited basically is promising the owner that if he will buy the asset at the end of the lease term, he will buy that asset at 1.5. So the owner of the asset believes that if he offers that asset in an open market, he'll be able to get a buyer to buy that asset at 2.5. So automatically the unguaranteed residue amount is 1.5. 1.5. Okay. So then we are told that the cost incurred by Pabana Limited and Mambo Limited in arranging the lease amounted to 2.1 million and 1.6 million respectively. So these are basically the cost of arranging the lease. And then you're told the rate of interest implicit in the lease is 9.49. You see the need of remembering the formula of computing the present value interest factor of annuities is because, like in this case, even if you have the table, there is no way you can be able to read the values for this from the table. You can see the rate we are given 9.4, and that's why it is always important to remember those formulas. So we are told Mambo Limited achieved the defined performance target as at 31st of December 2024 and made the required payment. I'll be able to explain what is that. Then you're told the following present value factors are given. So we're given the present value interest factors from year 1 all the way to year 6. Remember, this particular list is for 6 years, as per the first paragraph, the first sentence. So we're given the present value interest factors from year 1 all the way to year 6, basically at the rate of 4.94. So what are we required to do? We are required to explain how Pabana Limited we would account for the risk in its financial statement for the year which ended 31st of December 2024 in conformity with IFRS 16. How many marks were allocated here? 12 marks. You can see this was significant marks. And this question was basically poorly performed because, as you can see, the question itself is a little bit tricky, but very simple one. So now, basically what you have said is that this risk here automatically to the owner, that is to Pabana Limited, this one will be a finance risk. This one being that Mabo Limited, the company which is the asset, has the responsibility of ensuring and maintaining that particular good equipment. So therefore, from a Pabana Limited point of view, from the owner's point of view, this is a finance what risk. So therefore, we can say this is a finance risk. This is a finance what? A finance risk. A finance risk to Pabana Limited. To Pabana Limited, since the RC, remember RC is Mambo Limited. Mambo Limited has the responsibility to do what? To ensure and maintain. To ensure and do what? Maintain the equipment. That is the first thing which was important for the candidate to know, that this is basically what? A finance risk from Pabana Limited point of view. If that is the case, then we have said that Pabana Limited will have to recognize the asset, remove that asset in his books of account plus the statement for financial position, and then recognize something called the net investment in the risk. So that's what we need to compute here. The net investment in the risk. Net investment in what? In the risk. Net investment in the risk. Net investment in what? In the risk. Net investment in the risk. And basically, we compute this at the inception date of the risk. So the inception date of the risk, as per the first paragraph, the first sentence, this risk was entered into on 1st January 2024. 1st January 2024 is the inception date. 1st January 2024. So we compute the net investment in the risk. So how do we compute this net investment in the risk? We add the values. The present value of what? Of the risk rentals receivable, the present value of the guaranteed residue amount, and in our case, we have the guaranteed residue amount, and the present value of what? Of the unguaranteed residue amount. But if you check in our question here, we are given the present value interest factors from year 1 up all the way up to the year 6. So therefore, in terms of how we are going to compute this one, we need to have a table here. Take into account we are going to use those particular values we are given there. We are going to have year 1 all the way up to year 6, and then we have the risk rentals to be received here, including the guaranteed residue amount. Then we multiply them with the present value interest factors which are given. We get the present values, and then we get the total. So here we'll have year 1, year 2, year 3, year 4, year 5, and then year 6. So let's have the amount to be received. There is a rentals receivable. There is rentals receivable. Now, there is some information which are given about the amount to be paid by Mambo Limited. So Mambo Limited in the first paragraph, sentence 2, I hope you can see that. Okay, sentence 1 actually. So we are told on 1st January 2024, Pabana Limited acquired a large-scale custom-made equipment and leased it to Mambo Limited for 6 years. Mambo Limited makes annual payment of 10 million, commencing on 31st of December 2024. These are the lease rentals which will be received by the owner, 10 million each year, and this one is received at the end of the year. But There is also another information which also made the question to be tricky. So can we move to the other sentence? We are told the equipment has a useful life of 7 years. And then you are told in the other sentence, 𝐉𝐎𝐈 Limited is responsible for ensuring and maintaining the equipment and is required to pay an additional 1.5 million at the end of each year, provided the defined performance target is met. Now, in this case, we are told the company which leases this asset, 𝐉𝐻𝐈 Limited, will be required to pay 10 million. So this is basically guaranteed. And then there is another 1.5 million. And we are told that this will actually have to be paid based on a certain performance target being met. So if this particular equipment which was released by 𝐉𝐻𝐈 Limited will be able to meet certain performance targets, then this company will be required to pay an additional 1.5. And then there is also another information which is given in addition to that in paragraph 2. Where do we have that information? Not actually paragraph 2, paragraph 3. We are told the rate of interest implicit in the lease is 9.49. And then you're told in the other sentence, 𝐉𝐻𝐈 Limited achieved the defined performance target as at 31st of December 2024 and made the required payment. Now, let me ask here, when computing this one, net investment in the lease, whereby we discount the lease rentals receivable, are we going to use 10 million or are we going to use 11.5 million? This plus this. Who can tell us? Which amount are we going to use? Which amount are we going to use? I'm told by Mark 11.5. Which amount are we going to use here? I'm told by Sahin we are going to use 1.5. 1.5. Now, assuming, for example, in year one, this equipment will not meet. This machine will not meet the performance target. Will 𝐉𝐻𝐈 Limited be required to pay 1.5? Assuming the machine will not meet the defined performance target? Automatically no. So therefore, the amount which 𝐉𝐻𝐈 Limited has to pay is 10 million. And that basically what the owner of the asset will be expecting to receive at the end of each year. But if, for example, the asset has met the performance target in a certain year, 𝐉𝐻𝐈 Limited will be required to pay that 1.5, and the owner will recognize that as an income. So therefore, in computing the net investment in the lease, we will not use 11.5, we will use 10 million, because that is the amount which must be paid. The other 1.5 is basically pegged on how the asset performs. So if the asset does not meet the performance target in a certain year, that amount will not be paid. So therefore, you cannot use that in computing what the owner of the asset expects to receive from the lease. Else, we will work with 10 million. So 10 million here. 10 million is the amount to be received in year one. 10 million in year two. 10 million in year three. In year four, the same amount of 10 million. In year 5, 10 million. In year 6, 10 million. 10 million. But also in year 6 here, remember this when the lease will be coming to an end. In year 6, there is also another amount which will be received here. Actually, two other amounts. Who can tell us the other amount to be received by the owner of the asset at the end of the lease term here? At the end of year 6. How much amount will be received other than this 10 million? There is also another amount to be received. Who can tell us how much is that? So there is guaranteed residue amount to remember. The guaranteed residue amount is basically the amount which the owner of the asset expects to sell the asset. Can you remember that? Guaranteed 𝐉𝐻𝐈 Limited has promised to purchase the asset at an amount of how much? Yes. So in our case, we have guaranteed residue amount here. So guaranteed residue amount. So the guaranteed residue amount is 1 million. Is it 1 million? 1 million. That one will be received at the end of year what? Year 6. Also, we are told that if the owner of the asset basically will offer this particular asset, will offer for sale this asset in an open market, is likely to sell it at 2.5. So therefore, we also need to capture the unguaranteed residue amount. The unguaranteed residue amount. So the unguaranteed residue amount here will be the difference between 1 million and 2.5. And I think we have already agreed on how to determine that one. So these two amounts, remember, both of them will be received at the end of year 6. Are we together up to that point before we proceed to discount this? And the reason why I'm using this particular approach is because the examiner has given us those particular present value interest factors. Sasa? Yes, that's why I'm using this particular approach here. So having this, then I need to have the present value interest factors. The present value interest factors. So the present value interest factor for year 1 is 0. I'm using the values which are given here. 0.9133, year 2, 0.8342, 0.7619, 0.6958, that is year 5, 0.6355, year 6, 0.5804. This is still year 6. We are going to use this 0.5804. This is still year 6. We use this present value interest factor 0.5804. Sawa? Yes. So having those particular values, then we need to proceed and we get the present values. We get the present values. So basically, this is where majority of the students got it wrong, simply because here, majority of the students work with 11.5 instead of 10. Sasa, in this case, I've said you can't work without, you can't capture that 1.5 because this one is pegged. This one will only be paid based on the performance of the asset. So if the asset does not perform expected in a certain year, Mambo Limited will not pay that amount. Will not pay that will not pay that amount. So remember, Sahin, we can use this other approach here. For example, from year 1 up to year 6, you take 10 million, you multiply that with PFIVA at the rate which you're given here, basically for 6 years. And then this one, you do the same. Present value of this one, you take 1 million times present value interest factor at the rate of 9.49, and basically for 6 years. And then to discount this 1.5, you do the same. By the end of the day, you'll be getting the same answer. Are we together, Sahin? By the end of the day, if you use this approach, you'll be able to get the same answer. The reason why we must work with this approach is because we are already given those values here. But even if you use this particular approach, you can't fail to get the marks. Sasa? Yes, you can't fail to get the marks. So by the end of the day, the objective is to kill the cat here. Sasa? Yes, so there are so many ways of killing a cat. Yes. So what I want us to do here is basically to get these particular values here. So this will give us what? Remember, these are present values. These are present values. So we have, this will give us what? 900, and I think we could have worked with these particular values to what? In thousands of shillings. Yes, let's work with these figures in thousands of shillings. In thousands of shillings. So this one will be 10,000. 10,000, 10,000 like that. Yes. The same case here, our figures to be in thousands of shillings, such that this one will be what? This one will be 91.33. Is that the position? Yes, 91.33. The same case, this one will be 83.42, 76.19, 69.58, 63.55, 58.04. What about this one? This one will be 5.8. I think something like that, 5.8. What about the last one? What about the last one, which is 0.5804 times 1500? So this will give us, to the nearest whole number, 871. 871 to the nearest whole number. To the nearest whole number. To the nearest whole number. Now, having that, I want us to get now the total here. The total here. Let's get the total here, which will be the net investment in the risk. 81.33 plus 83.42 plus 76.19 plus 69.58 plus 63.55 plus 58.04 plus 5.8 plus 8.71. So what are you getting here? I'm getting 40. So confirm what are you getting? 45,662. 662. 45,662. Is that what you're getting? 45,662. 45,662. 45,662. I hope that is what you're getting. I hope that is what you're getting. Please confirm. You confirm whether that is what you're getting. So if you're getting that, I want us, we now proceed. We now proceed. And in our question, if you check on what you're required to do here, basically you're required to prepare the financial statement extract for this company, that is 𝐻𝐻𝐵𝐻 Limited, the owner of the asset, for this year, for the year which ended. That is basically what you're required to do. We're required to explain how 𝐻𝐻𝐵𝐻 Limited will account for the risk in the financial statement for the year which ended 31st of December 2024. So I think what we need to do, we basically need to amortize this. And are we going to prepare the amortization schedule for 6 years? No, simply because we are required to show the financial statement extract for 1 year. I think we need to prepare the risk amortization schedule either for 2 or 3 years. Yes, so let's amortize this. There is amortization schedule. There is amortization schedule. Yes, actually, we're going to prepare this for just 2 years because we need to have the net investment in the risk at the end of year 1 and at the end of year 2. Remember, the net investment in the risk at the end of year 2 will be recognized as an uncurrent asset. The difference between net investment at the end of year 1 and year 2 will be recognized as what? As a current asset. So we are going to prepare this just for 2 years. Remember, here we should have the first year which ended 31st of December 2024, 31st of December 2025, and then you're going to have the net investment in the risk at the start. The net investment in the risk at the start of the year. Then we have a column here for interest income. Interest will be computed at the interest rate implicit in the risk. The interest rate implicit in the risk is 9.49. 9.49. And basically here we will have the risk rentals. The risk rentals which was received. And finally, the net investment in the risk at the end of the year. The net investment in the risk at the end of what? At the end of the year. Basically, that's what you're going to have. Yes, so we need to prepare this just for 2 years. So we start with the first year. The net investment in the risk at the start of year 1, the year which ended 31st of December 2024 is this one, 45,662. Yes, now what we need to do is basically we compute the interest income, which will be 4.49. Sorry, 9.49. 9.49. We basically multiply that with 45,662. And that will give us what? That will give us 43. 33. So the risk rentals received at the end of year 1 is basically what we have here, 10. So this one, we should take this plus this minus that. So what are we going to have? 45,662 plus this minus 10. So that will give us 39,995. 995. So what is the interest income times the point? Okay, so we are getting what? We are getting 3796. Is that what you're getting? Yes, that is confirmed by Ida. Thank you, Ida. So then the amount which was paid here was basically 10,000. So what is the net investment in the risk at the end of year 2? So we have 39,995 plus 3796 minus 10,000, which will give us 33,791. 791. Is that what you're getting? Is that what you're getting? If yes, please confirm. I want us now we have the financial statement extract. Okay. So let's start by preparing the statement of profit or loss extract. And remember, this is basically for the year which ended 31st of December 2024. 2024, we are required to prepare this just for 1 year, just for 1 year. Just for 1 year. Now here, what was our company supposed to recognize here? So as part of other incomes, our company was supposed to recognize this amount here. And remember, our figures are in thousands of shillings. So our company was supposed to recognize the interest income. Now, the interest income, this one can also be known as the finance income. Remember, in case of interest expense, the other name for interest expense is finance costs. Equally, the other name for interest income is finance income. So the finance income is this amount here, 43.33. But in this question here, equally this company, the owner of this asset was supposed to recognize 2 other items. And we go to the information which we have in the third paragraph. In the third paragraph, we are told the rate of interest implicit in the list is 9.49%. Mambo Limited achieved the defined performance target as at 31st of December 2024 and made the required payment. Remember, there was an agreement between these 2 companies, the owner of the asset, Pabana, and Mambo Limited, which had listed the asset, that if this asset, which was listed to Mambo Limited, meets the defined performance target, how much amount is supposed to be paid by Mambo Limited in case the asset meets the defined performance target? Who can be able to remember that value? The amount to be paid by Mambo Limited if the asset is to meet the defined performance target? Yes, that information, we have it somewhere within paragraph 1, the last sentence, that if this asset meets the defined performance target, Mambo Limited will pay 1.5. Now, because you have seen this amount is not certain, this amount will only be paid once the performance of the asset meets this asset meets the performance target. So once that amount is paid by Mambo Limited, the owner of the asset, Pabana Limited, will account for that as what? As an income. Will account for that as what? As an income. So therefore, we also need to recognize that here. And that is basically what? Which name can we give to that? We can give, are we given the name for that amount, 1.5, which is to be paid? Yes. So we can just talk over 1.5. 1.5. Yes. Amount received. Amount what? Received. Yes. And we just refer to that as amount received. Although in an examination, what is marked are those values, amount received, and basically based on asset what? Based on asset performance. Based on asset what? Performance. Based on the asset performance, it will be recognized as an income. Then still there is also another item which was supposed to be recognized in the income statement. Let's go to paragraph 2, the last sentence. Paragraph 2, the last sentence. We are told the cost incurred by Pabana Limited and Mambo Limited in arranging the lease amounted to 2.1 and 1.6. This, remember, is the amount which was incurred in the first year of the lease. So the amount which was incurred by Pabana Limited, which is basically 2.1, that one will be recognized by that company. The income statement is a cost, as an expense associated with the lease. So we can talk of the expense of arranging the lease. Arranging the lease. Actually, this one, let's not mix this one. Let's not mix this one with because these are incomes, automatically that is a cost or is an expense. So we have the cost of arranging the lease. The cost of arranging what? That is the cost of arranging the lease. The cost of arranging the lease is the 2.1. The amount which was incurred by Pabana. The amount which was incurred by the owner of the asset, 2.1. I think those are the 3 items which were supposed to be recognized in the income what? In the income statement. What about the statement of financial position? In the statement of financial position, 2 items. The net investment in the list, which you are saying, has to be split into 2, non-current and current. So let's prepare the statement of financial position for the year which ended 31st of December 2024. So under the non-current assets, Other than non-current assets, current asset, our company will recognize. No, we don't have to get net income. Remember, this is an extract, Steve. This is an extract. We are just showing what was supposed to be recognized here. All the items of incomes and expenses are not included here. We don't have to get the profit or the loss. That's why we are referring to that as an extract. That is not a complete income statement. We don't have to get that. So under the non-current assets, so our company here will recognize something called the net investment in the lease. Net investment in the lease. And the net investment in the lease at the end of year one, and basically which is to be recognized as an non-current asset, at the end of this year will be this amount here. That is 3,781. 791. That's what we recognize here as a non-current asset. Still, under the current assets, we will also recognize, or our company is supposed to recognize the net investment in the lease. Net investment in the lease, of which the amount to be recognized as a current asset in the first year should be the difference between these two values here. The difference between those two values there. What is the difference between those two values there? What is the difference between those two values there? The difference between those two values there is the 6204. 6204. That basically what was required in that question. The candidates who are able to do that, they got 12 marks. They got 12 marks. So that basically what was required. But you can see this question was a little bit tricky. But I think the only tricky part was in relation to this amount, which is to be paid 1.5 to be paid annually, and which is based on which is pegged on how the asset would perform. I think that was the only tricky part, because you needed to understand that there was guaranteed residue amount of 1 million and a guaranteed residue amount of 1.5. Yes. So that is it. That basically what is required in that question, and that brings us now to the end of that area, how the owner of the asset accounts for the lease. So once we meet in our next class, we look on the last concept as far as this is concerned, how we account for something called the sales leaseback. Sales leaseback transaction. So that is what we will be discussing in our next class. I don't know whether there is any question before we wind up. Any question before we wind up? Aaron, any question? Mark, any question? Ida, is there any question? Phoebe, is there any question? Alfio, any question? Douglas, Frederick, Grace, Lewis, Raphael, any question? Steve? Okay, I think there is none. So we stop at that point for now. See you on Saturday as we wind up with this topic. So have a good night. See you on Saturday. all, a statement of cash flows, basically, this is one of the components of the financial statement which is prepared by companies, basically for the company to be. First of all, we need to ask ourselves here, what is an overseas, or basically what is a foreign subsidiary? So this basically a subsidiary which is operating in a country different from the parent company countries of operation. Like in this case, we may be told that a company which operates in Kenya has acquired a subsidiary which is either operating in Uganda, in TZ, or maybe like in Rwanda. So that particular subsidiary is operating in a different country from the parent company countries of what? Of operation. So such a subsidiary, we refer to it as an overseas, or basically a foreign what? A subsidiary. So therefore, this is basically a subsidiary company, a subsidiary company which is operating in a country different from the parent company country of operation. Country of what? Of operation. Country of operation. For example, in this case, we may be told that a company which is operating in Kenya basically has acquired a subsidiary which is, for example, operating in what? In Rwanda. So the parent company operating in Kenya, the subsidiary is operating in what? In Rwanda. So this is basically a foreign, or basically overseas what? A subsidiary. Now, in this case, how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency, using a different what? Currency. So this one, the parent company prepares financial statement using the Kenyan shilling, this one using the Rwandan franc. It is obvious that if you are preparing the group account, there is no way you can do a direct consolidation. You can do a direct consolidation. You take the asset and liabilities, revenue and expenses of the two companies, you combine them. You can't do that because you can see those currencies are different. The financial statements of the parent company is prepared in Kenyan shillings, and the financial statements of the subsidiary are prepared in what? In Rwandan franc. So in this case, we are going to look on how do we translate, how do we do the translation. But even before we do that, we look on that, and maybe there are some two terms we need to define here. One is something called a presentation currency, the presentation currency, and also something called the functional currency. The functional currency. So when we talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, currency used by the parent company, to prepare the group accounts, to prepare the group what? Account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group account using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group account is called the presentation currency. On the other hand, we talk about the functional currency. The functional currency, this is basically the currency, the currency of the primary economic environment, the primary economic environment in which a company operates, in which a company operates, in which a company do what? Operates. So basically that local currency of the country in which the company operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan what? Is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying Before we proceed basically to do the consolidation, before we proceed to add assets, liabilities, revenue, and expenses, those of the parent company in this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation what? Currency. Remember, you said the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? The Kenyan shilling. So therefore, before we combine similar items of asset, liabilities, revenue, and expenses, those of the parent company, those of the foreign subsidiary, asset, liabilities, revenue, and expenses of this company, that is a foreign subsidiary, must be translated into Kenyan shillings, which is the presentation what? A currency. So how do we do the translation? These are the translation rules. These are the translation rules. These are the translation rules. And this basically what is very, very important you need to remember. Number one, when translating the items of incomes and expenses, items of incomes and expenses, and remember in this case what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them. They are translated. Items of incomes and expenses are translated using something called the average exchange rate. The average exchange what? The average exchange rate. Because in both of these particular questions for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be given the exchange rate at the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. The average exchange rate. Number 2, when translating the assets and liabilities, the assets and liabilities of the foreign subsidiary into a presentation currency, these ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question, or the question for preparation of group accounts whereby we have a foreign subsidiary, they become very, very simple. But it is obvious that in the process of translating the assets, liabilities, revenue, and expenses of this foreign subsidiary into a presentation currency, there is something which is known as the translation, or basically yes, the translation currency difference, or can we just refer to it as the exchange difference? Exchange difference. In other terms, we refer to this as the currency translation difference. Translation difference. Currency translation difference is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference or this exchange difference can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to a translation. This arises due to translation of basically three items. One of which is goodwill. Is goodwill on acquisition. Number 2 is a profit for the year. And number 3, the subsidiary company opening net assets. So opening net assets. Opening net what? Assets. So we are saying that this currency translation difference, which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency, it basically arises from the translation of those three items. So I want us to look on how we determine this currency translation difference, which basically arises from translation of those three items. The goodwill, profit for the year, and the opening net asset of the subsidiary. So let's start with the goodwill. The goodwill. So remember, goodwill, this is the difference between the purchase consideration paid by the parent company and the net asset which were acquired. So basically, what is important, first of all, to note here is that when computing the goodwill, first of all, we compute the goodwill, or basically we say that goodwill is computed using the fractional currency, using the fractional. The fractional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwandan franc. So first of all, we compute the goodwill using, the goodwill is computed using the fractional or the local currency of the foreign subsidiary of the foreign subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it, into presentation currency. Translate that into presentation currency. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill. So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operates in Kenya, but the foreign subsidiary operates in what? In Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency. The local currency of the foreign subsidiary. We have a column here for the rate of exchange. The rate of exchange. You'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan shilling. So here we always start with the goodwill on acquisition. The goodwill at the date of acquisition. You'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, O for opening, the opening exchange rate, the exchange rate at the start of the year. We get the value there. And then out to this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that, and basically you read one line here. That now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency, and in this case here, because it's an item of assets, and we are translating that at the end of the year, Now we have to use which exchange rate? We use the crossing exchange rate. We take this, we translate it into presentation currency using the crossing exchange rate. We get the value there. The value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, and this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what we refer as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease, like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive incomes. Will be recognized in the consolidated income statement as part of other comprehensive incomes, part of other comprehensive incomes. So we know other comprehensive incomes, we add this to the gross profit. Not to the gross profit, sorry, we add this to the profit for the year, to the profit for what? For the year. So that's basically how we compute the exchange difference or the currency translation difference, which arises from the translation of what? Of goodwill, translation of a goodwill. So then from there, once we look on how we compute the exchange difference arising from translation of these two items. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference together here for those two items. The exchange difference on translation of those two items. So here we need to have the same columns. The local currency of the foreign subsidiary, the exchange rate, and the presentation currency. So always here we start with the opening net assets. The opening net asset. These, in other terms, are the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary, a foreign subsidiary will have been acquired at the start of the year. So take the opening net asset. The opening net asset on the date of acquisition in what? In local currency, for example, rand and franc. Translate that into Kenyan shillings using the opening exchange rate. And then to this, you add the profit for the year. The profit for the year. And remember, this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be affected in the income statement of the subsidiary, like a depreciation, other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, we said whenever the subsidiary has been acquired, the subsidiary can revalue assets, like maybe item of PPE or even things like intangible assets, like maybe Brad or something like that. So if that the foreign subsidiary revalued some assets, automatically it's never accounted for that. So if it is an item of PP, you have to compute the depreciation at the charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate. The average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the crossing net assets. The crossing net asset of the subsidiary. We translate that now into presentation currency using the crossing exchange rate. Using the crossing exchange rate, we get now the translated value there. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference or actually this one would be the exchange gain or the exchange what? Loss. So if from this to this, remember this net asset. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other a comprehensive what? Other comprehensive incomes will be recognized there as part of the other comprehensive incomes. So basically, this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of asset, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. The exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, you'll be required to prepare consolidated income statement, consolidated statement of financial position. I'll say for you to prepare number 1, the consolidated income statement. So before you even, or basically when combining the revenue and expenses of the parent and that of the subsidiary, you'll take that of the parent, which is already in presentation currency, but you have to translate that of the subsidiary. We have said that all these items of the subsidiary will be translated using the average. All items of the income statement will be translated using the average exchange rate. But the items of asset and liabilities, those of the foreign subsidiary, will be translated using the crossing exchange rate. Crossing exchange rate. So if you can be able to recall that, basically this one is quite simple. Quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. One of the areas which is very simple. Very simple. Yes. I want us to do a question with both the income statement and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022. April 2022, which is the question number 1. Question number one. April 2022. So if you're there, you can just confirm. Yes, are you there? Are you there? Okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the Securities Exchange listed in the Securities Exchange. It has diversified its activities by acquiring 𝐻 Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while 𝐻 Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is 𝐻 Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the local currency of that foreign country is franc, which is denoted by FR. And then you're told the draft financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct translation. Sorry, direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those that statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we are saying even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings, that of the foreign